very pleased to welcome in our continuing coverage on what Budget 2016 will deliver, Kalpesh Maru, partner, BMR and Associates. He's going to weigh in today on what the realty sector needs and wants and expects realistically from Finance Minister Arun Jaitley. Mr. Maru, thanks very much for joining us today on NDTV Profit. This is Manvi here in the Delhi studio. Let's get right to it. India doesn't have a single real estate investment trust. The framework's in place, but the fact that you don't have a single REIT suggests that the tax system around REITs is not very conducive to REITs functioning in India. What do REITs need to actually sort of take shape and form in India?
Manvi, clearly REITs need significant changes in the tax policy. The policy has been evolving over a period of time. So some changes came in last year, but clearly the 2-3 big things that are required from a REIT legislation perspective to make it attractive, principally for sponsorers as well as investors of REIT, is the dividend distribution tax exemption from distribution of dividends from an SPV back to a REIT. That demand, if met, I think will be a significant impetus and driver for operationalizing a REIT in the country. And clearly that's number one on the list. And if the government is generous, what might be helpful is if they relook at the entire exemption regime, because the way the REIT laws are designed from a tax perspective currently is that the government exempts a sponsorer from transferring shares of an asset-owning company into a REIT. What is not exempted is transfer of actual assets into the REIT. Clearly, that's the way world over REITs function most efficiently, because then you remove a layer of taxation and a corporate structure. The best situation for the REIT would actually be if the assets are in the REIT and the government provides for a capital gains exemption for companies to transfer their completed assets directly into the trust, which then lists and becomes an operational REIT. There are two elements. One element is the capital gains, which is within the purview of the centre and which is very much within the scope of what the finance minister can deliver on the budget day. The second change that is required is something where the state government will need to weigh in, which is to provide, if this were permitted by the central government, for the state government to then pitch in and come up with a similarly conducive stamp duty legislation which allows a beneficial rate of stamp duty for movement of assets directly into the REIT. So two big changes that are expected. Clearly, if these are made, we think that a significant market will open up. Already there is a lot of foreign interest in completed assets, and a robust REIT framework is something that will clearly open up the sector substantially. It will bring in much needed funds to the developers. It will help them deleverage their balance sheets. So the benefits from REITs are immense. I think the government recognizes that more or less the policy framework's there. I think they just need to iron out a couple of tweaks and hopefully we get going from there.
Okay, there are some, finer points as well there when it comes to REITs, and I want you, for the benefit of our viewers, to sort of run through the exhaustive list. I'm referring here to the expenses of, business trust and the allocation of business trust expenses to income distributed to unit holders. Just some detail and clarity on how that would be helpful too.
Sure. So one of the concerns of the industry has been that once the REIT regime is in place, the manner of the entire mechanism in terms of computation of the tax liability is clear, transparent and free from ambiguity. What is not clear today is what are the nature of expenses that the trust itself, which earns the income, what are the expenses that the trust can claim in computing the taxable income. And why this is important is REIT in a way is a pass-through vehicle. So what really we need is clarity on the expenses that are deductible and the manner in which the income of the REIT then gets allocated to the investors, because what the rules currently say is that the allocation principles are broadly established to say that the nature of the income is going to be of the same nature and of the same extent as if the trust had earned the income. But what will be useful to avoid litigation is a clear formula to say that if $100 of money is getting distributed by a REIT back to the investors, what are the clear rules that will apply for classification of that income into dividend, capital gains, interest income, as the case may be. So that is something that is important. Sorry, man.
You know, I was going to change gears a little bit because we have a fair bit of ground to cover, and SEZs is the next bucket which is of importance and focus in our discussion today. You know, these SEZs find themselves in a bit of a conundrum, don't they? So in light of the budget on Monday, what are the most pressing tax needs of SEZs that should and perhaps will be addressed in the budget this time round?
So, I mean, like you rightly said, SEZs is unfortunately caught in the middle of a serious turf issue. I mean, the need for an SEZ, the fact that SEZs as a policy, at least on the services side, have generated significant exports has not been in question. You've had the Commerce Ministry, which has been promoting SEZs significantly. You have a very ambitious Make in India program that is running, and the government is going all out to woo manufacturing in the country. But on the other hand, the manner in which, on the tax front particularly, the SEZ policy has evolved leaves a lot to be desired. Take the case in point, I think needless to say that SEZs by definition, given their size, scale of investments, are large and high investment projects and therefore typically tend to have a long gestation period. When the policy started, the developers of an SEZ were promised exemption from income tax, corporate income tax, exemption from MAT, and exemption from dividend distribution tax on profits that were distributed by these SEZs back to their investors. Midway through the policy, a change happened. The MAT exemption sort of was taken away, and so was the DDT exemption. I think it's been a few years, and each year I think one of the asks from the SEZ developers is to restore back this benefit. And even as this demand continues, the government, as a part of its white paper on the phasing out of tax exemptions, has come up with a proposal to sunset the SEZ holidays. Now, there are two elements that are important here. One, the government is saying that all SEZs notified up to 31st March 2017 will continue to get their benefits, and units that have set up their operations prior to this date will be eligible for exemptions. Take an example of a 2,000 acre SEZ which is, let's say, approved in 2015 or 2016. By the end of 2017, given the size of the project would really have just started taking off. And if at that stage, one of the key incentives available to a developer from a marketing perspective, which is the tax holiday for units that set up shop in that SEZ, is taken away, it's a significant hit. It's a hit which is in some sense not budgeted or modeled at the time of making the investment decisions on the SEZ. Right. And therein lies the problem, that midway through the process you've changed the law. Yes, it's prospective change, but the prospective change impacts an already large commitment that has been made, and this is something that the government needs to look at.
You know, there are again some finer details associated with that. You know, the way the co-developers come on board as far as SEZs are concerned, and the tax implications for them as well. Walk us through, you know, scenarios involving co-developers.
No, I think the story for the co-developers is exactly the same. I think I think the case that is being made out is that nobody questions the need for phasing out tax holidays in the event that the government is simultaneously and in equal proportion reducing the corporate tax rates. Now, if this were the policy direction, what would you do in relation to units and or co-developers in a manner that you would not affect their business case and their investments that are already made? So one of the proposals and asks from the industry is directionally, if you want to go down the path of sunsetting the SEZ benefits, is there a way that we can look at it in a manner that the benefit for co-developers for a SEZ that is already set up prior to 2017 should not be taken away, notwithstanding the fact that co-developers or for that matter units set up operations after that 2017 date. In other words, the request is if I have a 2,000 acre SEZ, don't take away the benefits either for the developers or for the units till such time as the SEZ is fully let out, because doing so adversely impacts investment decisions both for developers as well as co-developers who would have invested in developing these SEZs and would have done it on the basis of a promise of a tax holiday and on the basis of a promise of a package of a fiscal incentive which includes benefits to the units.
Okay, I'm going to take a step back and ask you on the direct tax front, beyond what we've already addressed when it comes to REITs and SEZs, anything else that you'd flag off as a must-do to revive the realty sector? And I don't think we need to spend any time debating the need for reviving sentiment in the realty space.
Yeah, so I would think other than what we've spoken about, two things need to happen. I think clearly the fact that there is softness in different parts of the sector is evident, and therefore what we need is some moves and some efforts that are aimed at revival of demand. In that context, the case in point is the interest deduction that is available for buying property. If you think about it, the deduction that's available is at 2 lakh rupees and roughly that translates at a 10% cost of borrowing to a 20 lakh rupee principal amount borrowed, which in the context of things and the days that we are in of fairly significant asset inflation over the last several years, the number is simply insignificant. It sometimes tends to be a fraction of the interest costs that are paid by actual homeowners towards interest. And therefore, one of the things and demands which is long-standing is, can we look at something which is radical, something which is transformational by linking the interest rate deduction, and does the sector need it now? Clearly does. We look at data across cities of piling unsold inventory. So this is towards demand, to boost the demand. The other ask, and it's a rather simple ask. If you look at the real estate sector, I think it is perhaps one of the most regulated industries in the country, and it's regulated across multiple bodies or jurisdictions. So, I mean, it is one sector which is heavily regulated from a central law perspective with all the taxes, state laws, local municipal councils, and state city bodies. And a large part of the business is affected by serious amount of litigation. Now, while all of this is not in the purview of the finance minister when he's presenting the budget, what would be useful is if one could look at the key areas of dispute on direct and indirect taxes and provide some clarity. I don't think the industry is asking for an incentive. Well, they're asking for an incentive, but more than that, they're simply asking, saying, please clarify our rules. Just make them simple. If you think income from letting out of a completed building is house property, say so. If you think it's business income, say so. But don't start a vicious cycle of litigation where if one claims it as house property, it gets taxed as business income or vice versa. Same is the case with joint development agreements. Likewise is the same issue with a plethora of indirect taxes. So the ask is make rules simple, be clear about it, and let's please avoid litigation.
Invaluable insights from you ahead of the union budget. Kalpesh Maru, partner, BMR and Associates. Really appreciate your time here on NDTV Profit today and look forward to touching base with you on budget day and beyond. Thanks very much for joining us this afternoon.
Thank you. Thank you.